You'd mentioned you traveled. You spent a decade traveling the world.
Yeah, yeah.
Is that like where'd you go?
I started off very much like trying to live like the 4 hour work week
Oh,
dream.
cool. Yeah.
This was, everything's remote everywhere now, but like at the time, this was how
Yeah, Tim
old were you?
Ferriss, revolutionary. Yeah.
Yeah, this was like 16 years ago or something like that. It was pretty revolutionary. And so I built a first little teeny tiny business and went and like lived on this little island in Thailand for a while. I was like, I'm gonna retire at like 24 and just like
Yeah.
dive every day. And like I did that for a year. Realized like that wasn't the life I wanted.
Did you like
But I'm glad I experienced it, right?
Yeah.
It's better to realize young, like that's not the thing, than to work until you're like 65, then retire, be like, oh crap, this isn't what I wanted all along. And I've been like putting it off.
Yeah.
And so then I just kind of like, I backpacked around for, I don't know, 4 years or something like that.
Give us some picture. What's like your favorite country location that you went to?
There's really not one. There were, so for context, I backpacked around for a few years and then I would like live in hubs for long periods of time, like sometimes like multi-years.
Mm-hmm.
And I feel like each hub was really right for me at that time in my life. And they were great. And so like the hubs were Bangkok, well, actually the island called Koh Tao at first, but that was, I was a young kid.
Yeah.
Then Bangkok, Ho Chi Minh City, Saigon's like an incredibly vibrant city, like very bullish on those people long term. Taipei's amazing. Like, but again, if I'm like a 24-year-old kid, probably not as much fun.
Mhm.
Prague and Barcelona, like those are the
Nice.
hubs. And a little bit of Bali in there too.
Yeah.
Again, it was great at the time. Now not as much. But so I can't really pick a favorite because all of them like really scratched the itch that I needed at the time.
What was like the deciding once you like were there for about a year, you're like, I'm kind of done with this? Is that kind of how it went down, or?
Each place has its own friction.
Yeah.
So like let's take Barcelona. Good chance that you guys or a lot of others have been to Barcelona. It's the quality of life is fantastic. It's slow. It's beautiful. It's great weather, but there's also this like bureaucracy is not the right word, but like everything's difficult to do. There's a total lack of hustle, which is both, good and bad.
Yeah.
And so it just kind of like gnaws at you over time. Bangkok, on the other hand, has anything you'd ever want to do. It's amazing. It's got plenty of hustle. It's got world-class everything. It's incredibly affordable for like what you get. But then at the same time, like the climate's kind of rough. There's kind of pollution.
Mhm.
Getting around is like traffic and stuff like that is very cumbersome. So you have to, and so like each place has its own little thing that kind of rubs on you. Taipei is amazing. It's probably the safest place in the world.
Mhm.
Maybe Singapore is safer, but it's right up there. It's the nicest people. You could like leave your laptop on the sidewalk, come back 2 hours later, it's going to be there. It's also a place like English isn't enough. Most places English is fine, but like Taipei, like you need to speak Mandarin, and I don't.
Yeah.
So everywhere has this thing.
Yeah, for sure.
What business were you running while you were doing all this?
Many of them.
Many of
So I kind of used like
Yeah, let's use this to dive into your background. Yeah.
Rob Walling is the Uber founder. He's the founder of Tiny Seed, like a kind of like a fund that invests in like tiny SaaS businesses that aren't trying to become billion-dollar outcomes on purpose. And then they've done very, very well. I'm an LP. Anyway, but he's talked about the idea of like stair stepping. So you build a business and it's small because going big is hard at first, and then you use the cash flows from that. It's a profit focused type thing, not venture pie in the sky stuff. Use those profits to build something bigger, or you sell it and use those proceeds to build something bigger. And so that's kind of what I did, like over 10 years, maybe 12, something like that. I had e-commerce companies, so a marketing agency, a couple of different SaaS products, newsletters, info sites, physical goods, health stuff, just absolutely anything. No rhyme or reason. I think I'm just one of those like founder personality types. Like I think of something and I get initial traction on it, and then I'm not really the best person to take it from there. So I either need to like put like a great management team in place, which is very difficult. It's easier said than done, or sell it. And so I sold about half of my companies The other half that I still have, I have like really good management teams in place that kind of like operate the day to day and stuff like that. And I just kind of like oversee it, although they don't really need me, to be honest. So I don't oversee that much.
Yeah.
Yeah.
Okay. Very cool. So you had these multiple businesses, and so take us through that. So the ones that you sold, I guess, how did what did that process look like for you?
So it's very different. Like, I mean, the first one I sold, again, I was a much younger kid. It was for like, I don't know, 55,000 or something like that, which, to be very clear at the time, was a very meaningful amount of money to me. I did not come from a privileged background. Then the next one was like 150,000, and then we had one that topped $1 million, and then they, kept getting a little bigger from there. So the processes were very different. Like on the small scale, it's just going to a broker and being like, I don't want this thing anymore. Can you sell it? And they do. The larger scale, like a private equity-ish fund out of mainland China, like acquired the SaaS company.
Mhm.
And with that, and that was, to be fair, that was probably way easier and weirder than it should have been.
Say more.
I mean, it's just China and everything's different. And I actually bet it's more buttoned up now than it was at the time, but it's a little more Wild West. This was, a decade ago.
Yeah.
And the people that acquired it, they were really good at kind of like selling the dream to LPs. So they raised the money, and man, what they said sounded really good. And so they acquired us. They were doing like a kind of a roll up in the Amazon space. And we had an Amazon software for like sellers and stuff like that. It was
Nice.
wildly popular. And it was just like kind of a massive lack of due diligence. Like in retrospect, I didn't realize this at the time because I didn't know any better. But in retrospect, I'm like, what? How did this happen? They just like cold called me. Then like, I think I was living in Bangkok at the time. They just flew over to Bangkok and like hung out. We had offers within like a day. We stayed on for a bit. It was weird. And it was also really sad because it was a product that was doing really, really well. The growth rate was like Silicon Valley style growth rate. I didn't realize how good it was at the time. And then they acquired it, and they just did not have any skills.
That's
They were storytellers, and they were great storytellers, but they didn't have the operational skills to keep it going. So they bought a couple other things too, and they just killed everything. There was a very big like cultural like gap, and between like what they could think. So like in mainland China, you have WeChat, and you just if you just want to spam all of your users like 5 times a day with messages, that's just what you do, and it's normal and it's cool. And they got the business. They're like, oh, we're going to email our email list 5 times a day. I'm like, no, you aren't. No, like you can't do this. And they would just do all these things that just like, oh, we can do this like kind of sneaky thing to extract more money. I'm like, you're going to kill the trust. Like trust is everything with this. Also, the team. I learned so much of this. This was a painful lesson. The team went along with it, and everything was fine. It was a remote first team. It was mostly a bunch of expats that I had like brought to Bangkok just to have a central hub for a while, and everybody stayed. But it was remote before remote was really a thing.
yeah.
And then like a few months into it, they hit a speed bump, and like, oh yeah, everybody's got to move to Shenzhen within like a month. We're like, what? And obviously, most of the team basically like lost their jobs because they're not moving to mainland China if they even could. A couple of people did, and like that was pretty crappy to see. So learned a lesson from that.
Yeah.
Yeah.
Is there a happy ending? Did you at least get paid from it, or?
Oh yeah, I mean, finance was a great ending for me, and that's why I like invest in stuff is because of that sell. So here's the interesting thing. So if they came to us with an offer, and the offer was for, we'll just say like life-changing money, and we kind of thought about this because our growth rate was absolutely bonkers. And we knew if we could hold on to the business for a little bit longer, the amount of like money we would get for this would be like way, way more, multiples more, because of its growth rate. But we also knew the business had some risk in it, right? Like Amazon could have changed their terms of service in one snap or like one thing, and like the whole business would be done. And so we thought about this, like, do we accept this like life-changing money, or do we wait and like risk it and try to get multiples of this life-changing money? And so we started like basically thought about this, like if you chart it out and you look at like the utility of money, it's kind of, I don't know which way to do this on a camera, but like So you're just starting and you have like, oh, you can now buy a car. Oh, you can, don't look at prices at restaurants. You can buy a house. And then you reach this like freedom line and utility of money shoots up. And it's like, where like you don't have to like work anymore if you don't want to. But then after you cross that line, it kind of slows back down. The utility of money still increases. There's a big difference between not having to work and like private jet money. Like that's a really big difference. But it doesn't change like your life that much. That like freedom line is the thing.
That's sort of level.
Uh, And so that's where we kind of thought, we're like, well, I guess we sell. And we did. And that was actually the wrong decision in retrospect. If we had held on to it, we would have made so much more. And we also wouldn't have killed the product. And it would have been, like probably 10x, maybe 20x bigger than we did. But I still think the actual decision was correct at the time, even though you don't want to base, like, was this a right or wrong decision? You don't necessarily need to base it on the outcome. You base it on like the information you had and the decision that was made. And I think the decision was correct, even if in retrospect, the outcome would have been way better.
Yeah.
It sounds like a great learning experience though, from what you went through. This is a stepping stone, right?
Yeah. Oh, yeah. I thought I was hot shit. I thought I knew everything. I knew nothing. I knew nothing in retrospect. And I hope I say that about myself now in a few years, but
What was what year-ish? What was this that happened?
roughly a decade ago, something like that.
I'm just curious because Amazon, I actually had an Amazon business back in the day too. And there's a lot of things that change over time just with analytics and how you track stuff with Amazon.
Maybe you used this AMZ tracker.
Yes, I did actually.
Yeah,
I did. Yeah. I had a supplement business we were selling on Amazon. We just exploded. And to your point, and then we just found ways to track it. So yeah, that was actually a really great system, man. Yeah.
It was amazing. We hacked the system big time there. Yeah, but so I mean, at that time, that's when like the Amazon kind of FBA seller space was really exploding, and it was the Wild West. Like,
it was.
You think of like I mean, it started with just like a spatula or a garlic press. It was like the meme, and you just throw it up there and you become a millionaire. Yeah. But then it came, you're just finding these little industries and niches. Yeah. Supplements was a great one. I was involved in that as well. Yeah. All kinds of ways that just meant money. And now it's really competitive. You got to be really
10 spatulas now. 10 different companies with 10 different spatulas, right?
Yeah. I mean, it's probably 1,000 spatula companies.
Yeah. No, now you just got people buying stuff on Temu and just reselling it on Amazon.
I think it's even more than that. So that's what happened. First, it was just us. Then it was people buying on Temu and whatever and Alibaba and selling it. And then eventually the Chinese manufacturers themselves figured it out.
Yeah, right.
And now they're going direct because like the gap was just cultural and marketing and language and stuff like that. And enough people have filled the space to like close that gap. And now AI is completely closing that gap.
100%.
Yeah. And now if they could just fix the names of their companies in the Amazon descriptions, like crazy long thing. If they do that, like it's done. Like you have no idea what's going on. Yeah. Like just get a Wyoming LLC and you're done. Nobody knows the difference.
That's right.
Yeah.
No kidding. Well, cool. Well, this is a great intro, Travis. Talk to us about what you're doing today. Talk to us about your current company.
All right. So now I basically just invest in small business acquisitions. To kind of like give probably a little background of how we got here, I think is pretty relevant. Yeah. So post exit, so like the software exit we talked about was one, and I had a few others as well. You gotta get cashed up, and like the next logical step that everyone does is they go from entrepreneur to investor. I mean, if you're listening, that's in quotes. It's generally probably a bad idea, but like I did it, and so like I played in like every asset class imaginable, and kind of circle back around to like, what, like actually these small businesses are printing machines if they're good, right? I think they have like small businesses have the best returns out of like any asset class that's around, but they have a lot of drawbacks, and those drawbacks are one, you've got to run them, pretty big drawback. Yeah. Two, it's almost impossible to diversify. Like I've kind of diversified like my personal holdings that I started with management teams, but that is a decade-long process and very difficult. It doesn't work a lot of times. And then it's risky. Like, if you just have one small business, it can, make, if you're looking at like yield purposes, like, 30% a year yield, but it can also fail and it can go to zero. Where like, your S&P index fund's not really going to do that.
Yeah, right.
And so I was, for years, I kind of like tinkered around, like, how can I solve this? And I kind of just stumbled into this space of, specifically, it's kind of like search funds, self-funded search funds, and independent sponsors. This is kind of the terms that they use to describe it. It's essentially people, sometimes individuals, sometimes small teams, that are acquiring legacy profitable small businesses. And I say small businesses, the smallest might be 500K a year EBITDA up to maybe like 5 million a year EBITDA. This is kind of the range depending on the different models. But they're not startups. They are, think of some boring company that's maybe been around for 30 years, historically profitable, and maybe the owner's retiring. Like, this is kind of the profile that you hear mentioned a lot, and it's true a lot of times. This happens, and somebody comes in there and buys this company, and they use a mix of debt from banks, and then or private credit, and then a mix of investors from people like myself. And what that ends up doing is, at the end, we just become a passive owner of these small businesses that are profitable. Again, it's nothing like a startup. They're not getting money to like grow to the next level. It's just to own this profitable business. And that's kind of like how I'm gonna say hack the system. I just kind of discovered, like, oh, this is how I can have the returns of small business, which are incredible. I can diversify. I can have it's passive, have other people run it. And diversify. So it kind of like checked all the boxes, and the space is kind of incredible. And I think the returns are so good for like several reasons, but one of the big ones is you can't have large institutional capital enter the space because it's too small.
Right.
You can't have endowments with billions of dollars come and dilute stuff like's happening in venture right now.
100%. And as you're talking about this, I mean, the first thing that comes to my mind, she's pretty well known now, Cody Sanchez, like small business guru. She's always saying, by the car washes, by the dry mat, laundry mats, by those boring businesses. Does that kind of resonate with you all?
Yes. I mean, she's a social media figure, and so everything she says is with a little bit of a grain of salt. But like a lot of that basic premise is roughly true.
Yeah.
Like, I mean, there's like an actual real world example. I'm not too interested in like a coin laundromat, right? As she talks about. But I'm definitely interested in like a luxury dry cleaner in Miami, which is a very real deal that I did. Like something like that. Like, so yeah, there's a lot of truth to that. And the whole system's really good. Low failure rate, high returns. We go into whatever direction you guys want to go. I hadn't even talked about the actual company yet. Just talk about like the investing them.
No, it's all good.
I
wanted to ask you, Travis, because you talked about this earlier, which is interesting. So you kind of laid out how you started, and obviously I'd love to hear how you kind of got your first deal in this space as an investor. But your mindset, you kind of mentioned to us more about self-awareness. You like to start companies, but you don't like to manage them, right? Run them. This is actually an interesting situation because now you are taking legacy businesses that have been run for decades, and you're coming in and either, changing the management or, making it more efficient. I'd love to hear kind of that process too.
That's a really great point or question. So to be very clear, I am not coming in as the operator, or I'm just a passive owner.
Right.
Like the way the system works is, let's take there's different types we talked about, but let's take the self-funded search fund. That is generally one person, sometimes two, maybe a lot of like MBA types, a lot of like former special forces that then go get their MBA, do a few years of real world experience, sometimes former private equity people. They decide to go and buy the business. So they search for a couple years, on average, maybe a year. If they're lucky, 6 months. They find this business, they diligence it, they put in the offers, they get it accepted, and then they come and like round up the debt and investors from people like me. Post acquisition, they run it.
Got it.
So it's not me making the calls. Now, I am an advisor. I have a lot of sway, but at the end of the day, like, the point is not for me to run it.
Right.
It's kind of like I'm going to board of advisors. It's not a technical board because of the situation, we can't actually fire the CEO if we wanted to because the debt covenants. But yeah, that's kind of how it works. And I think this is a really good fit because there's there's a huge band of like different types of entrepreneurs. I am very much a 0 to 1 entrepreneur, 100%. But then there's like, 1 to 100 entrepreneurs. And the people buying these businesses are people like that. On average, they're not the best people to start from scratch, but they can take something that already exists and improve it forever. Because a lot of these businesses, if it's decades old, they've been doing a lot of things really well because it's obviously survived that long. But a lot of things people get blind to, founders get blind to, or they just don't care. Like, again, that Miami dry cleaner deal we talked about, that was a hard one to get the deal done because the owner was always out on his boat. I'm dead serious. Like, he was in Miami, so he was always on his boat. And so we couldn't, it took like an extra 2 months. Like a business like that has a lot of low hanging fruit, surprisingly. Yeah. Or this business that we just closed, it's like a New Jersey, like home improvement one. I'm looking, again, because I'm an advisor and I have a lot of like, technical marketing backgrounds. I'm like going through their agency stuff. And I see this agency that the company's been paying like several $1,000s a month, and they do nothing.
Wow.
In fact, they do worse than nothing. I think they're harming the business, not intentionally. They just don't know any better with like terrible, terrible SEO. And so I'm like, well, instantly we're saving, thousands a month from this, and we can actually do good stuff afterwards. Like, there's a lot of low-hanging fruit with stuff like this.
Yeah.
Yeah. So give us in a nutshell. So Capital Pad.
Yeah. All right. So yeah, let me pitch myself. So from getting into this space, I kind of discovered the hardships with it too. And there's two sides. From the investor point of view, it's really hard to find these deals. Like, I mean, probably most people listening, probably you guys as well. Like, you hear this, oh yeah, find a great profitable dry cleaner trading for like 3x earnings. That's amazing. But where do you go to get that? It's not commonly available. It took me years to build up like deal flow to get these things. Because again, with deal flow, you're not saying yes to everyone. You need to say yes to like 1% of them, right? So you got to see a ton of them. So that was one of the problems. The check size minimums were quite large. These like the deal rooms and presentations were all over the place. There was nothing standardized. And I had a lot of people asking to co-invest with me, like friends, like, oh man, this deal's awesome. Can I like invest with you? I'm like, yeah. Eventually I was like, I think we can like make a platform off of this. And on the other side, the people who are buying these companies, it's really difficult for them. They find the company, which is, God bless them, that's a very difficult thing. They diligence it, they find a good deal, and then they got to like start cold emailing like hundreds of investors, right? Yeah. Saying, hey, here's this thing. Oh, you got to sign this NDA before I can even like, show it to you, like because of like the broker stuff, like all these things. And then they got to get tons of different wires and signatures all over the place. Is like, I think we can make a platform to fix this. And so we did. And it's Capital Pad. And Capital Pad is like, it's a platform where the sponsors bring the deals and they present them to accredited investors only. And accredited investors can choose to invest on a deal by deal basis. And essentially they can passively become an owner of like a profitable small business, just like I'm doing myself.
That's really,
and I've invested every deal myself.
Yeah. Yeah. What were the typical ticket sizes on the platform?
So we set the minimum right now at $10,000 per deal. Ticket sizes are usually like the check sizes are usually larger than that. We might have to raise that just for like, the low check sizes can sometimes be difficult, where the larger ones are not, which is kind of crazy. It's always that way though. Right. But right now that's the idea. But say if they're deals raising, I think the last deal raised like what, 740,000 or something like that. So there's room to split it up and whatnot.
How are you guys setting this up? Are these like debt, equity, and that? Yeah, I was going to get to SUVs too.
Yeah, we only do equity. They ask us for debt sometimes, and I'm just honest. Like, I don't know how to price this debt.
Okay.
Yeah.
So these are equity deals, and what type of stake are you guys looking to get in these businesses?
It depends on the type of deal. So with the deals that are probably $7 million and under, they're usually using an SBA loan, SBA 7A loan. And with that, we will never own over 20% of the business. We will own up to 19.9%. Because if we go over 20%, we've got to personally guarantee that debt.
That's right.
And we're obviously not going to do that.
Yeah.
That's the searcher, the people doing that. That's what they're doing. And they're being rewarded handsomely for that. To be clear, so these are great returns for investors. Historically, I think I got to say, but the searchers and people doing these deals, they come out like bandits too. So it's really a win-win if it goes well. And if it goes badly, well, obviously we lose our money, but they lose a lot more because they're personally guaranteeing this with the SBA. Like you can't just walk away from government guaranteed debt.
Right.
Yeah.
Yeah.
Very cool. Okay, so you guys are structuring these as SPVs to make these 20% or less investments, or less. I should say less than 20%.
Yeah, I assume most people know what that is, but just in case, we use a specific company for this, but we spin up a LLC with dedicated bank account and all this stuff, and pool all investors into one SPV, one of those, and then invest as like one entity on the cap table. It all goes through there.
Yeah.
I'd like to simplify it all.
Okay, and then the folks that are coming to you guys for these loans. So I'll just try to make this investments. Sorry. So to like kind of let's say, so I'm here. I find a gorgeous laundromat in Miami, and I need to get some capital for it. So I'm taking out an SBA loan, and then I'm working with you guys, and you guys are giving me a 20% or less than 20% equity stake in this company. Is that correct?
All right. So let's say, just for simplicity's sake, let's say it's a $5 million total like enterprise value deal. With the SBA loan, you can get, the specifics vary per deal, but we'll just say 80% might be SBA, right? 10% might be a seller note. So the seller's kind of giving them some debt, pretty cheap debt generally. And then that also helps keep like skin in the game for the seller. So if like something doesn't go well, they don't have to pay off the seller note or something like that. Yeah. And then the last 10% comes from investors. So in that $5 million deal, we'd be putting in $500,000, so the 500,000, and we would own. Well, we'd put in something like 490,000. So at the end of that, we'd own, right at like the 19.9% or something like that. Yeah. So here's the thing though, because you just might have heard my math and be like, wait a minute, Travis, that's 10%. How did you get to 20%? So if we, $5 million deal, we'd put in $500,000. We essentially own, that's 10% of the equity, but we essentially own like 20% of the company at the end. There's something called it's a step up, and it's a terribly explained, convoluted term that doesn't really make sense. But essentially, it's a multiple of the money you put in to the equity that you get out from the company at the end. Right. So they like just multiply it from there. So it's a 2x step up in that case, and just pretty standard terms. And you get in that case, it'd be like a 10% preferred return, 1x liquidation preference, and then the 2x step up. And in that case, the models, we work out like models for all these. We're like, a model in like venture is completely useless. It means nothing. But a model in these types of companies are far more realistic because you can historically see what they've done. And these sponsors, they love to give us models with all kinds of growth and stuff baked in. And I discount all of that. Like, some of these companies, like this one I talked about, like, there's a lot of growth levers, but I don't want to like bank on that. And so we kind of put it in the model, like, all right, if we just increased like revenue at like the pace of inflation, so basically like 5% a year type of thing, with no growth, no like improvement in no increase in like the exit multiple or anything like that, do we still come out at like over 30% a year IRR with our investment? And that's what we have to do in order to invest in these things.
Okay, that's really, we'll definitely get into that a little bit more. One thing before we move on, I just want to dive into like the SBA loan. Could you kind of just talk about just give us a little bit more clarity on it? What is it? Obviously you mentioned like government loan. Is it, I'll let you take it away.
Yeah. Don't exactly know where you want to go with it, but I'll just kind of ramble. The SBA has a really nice program. There's SBA loans for all kinds of different assets, but in this case, it's the 7A acquisition loan, is what they say. And it's kind of put in place to help people acquire companies, but not necessarily. It's not to like help fund private equity. It's to help transitions. Somebody's owned a company they've owned it for 20, 30 years. Like they just don't just
Sure. I've been working for some HVAC company for 20 years. I don't have a $500,000, so I take out this type of loan. Is that kind of right?
Yeah. And it's to be clear, it's a government backed loan. So it's not like the government's doing this. There's tons of individual banks that are making these loans, and it's government backstopped. So if the loans go bad, and the bank has followed the rules that the SBA has set, which are pretty rigid, I have to say. If the loans go bad, then the banks can get like 90% of the money back from the SBA. The good thing about this program is it essentially costs taxpayers nothing. So because the SBA, they charge fees for people taking out these loans to like pay for this. And they reevaluate this every, I don't know, year or two. I don't know exactly how often it is, but so there's been some like more defaults over the last couple of years because of like crazy COVID money and valuations and interest rates going up. And so the SBA said, all right, well, we're going to charge more for our fee because this isn't going to be a taxpayer subsidized thing. Right. The whole point is to like backstop it to like kind of help facilitate the market. Right. And so that's what they're doing. And essentially an individual can get one of these loans to help buy the business. They have to have decent credit. The banks are underwriting them too. Like just because Uncle Sam says we'll give you your money back if it goes bad doesn't mean these banks want to make bad loans. It looks bad. It pisses off the SBA. And so they're looking like, is the sponsor, the searcher using this? Are they qualified? Do they have a good background? Do they understand it? Is it a good business? Can the cash flow support the debt? That's probably the biggest one. And then they have to personally guarantee it. So they have to pledge all their assets. They have to pledge their home, like everything, absolutely everything they've got to pledge. And so really they're nuts on the line. And that is good and bad. It's heartbreaking when it goes bad. And to be clear, the failure rate's not that high, but it's nothing like venture. These are boring, profitable businesses, but it's still real. But it also really aligns incentives. So they know that if they just keep one of these companies alive 5 to 10 years, they're, rich. Maybe not, 100 million rich, but they got a lot of money. They're multi-millionaire. They're a multi-millionaire if they just keep it alive, pay off the debt, all that type of thing. And from the investor point of view, you've invested with someone who has ultimate skin in the game. The incentives are very, very much aligned. And to go even further, let's not even take about the business going bad. Like if business is going well, they're also very aligned because they want to pay off these searchers want to pay off the investor's initial investment and the preferred return so that they can then convert to common equity. Because the investors are really expensive during this time. And once they convert to common equity, they just become passive shareholders. They don't get the special 10% pref on top of it.
Thank you for clearing that up.
Great.
Let's so I got a lot of questions on these businesses. So the businesses that you guys are purchasing, I guess let's start with like the due diligence side of things. So how do you and your team or the investors go about due diligencing these investments?
The first part is like, a really common question is like, well, what are you looking to invest in? And I think I would actually, as Munger always said, like, invert it. We're looking first at like what not to invest in. And so, we look at deals like every day, all day long. And so it's really more about disqualifying things than qualifying them at first, because we're very agnostic. Like we don't have like an industry or a niche that we're looking at. In fact, we don't want that. Like I personally just want a very diverse portfolio of these. There's no like concentration risk. And so we're looking at the things to say no to. And so we can like, what's the thing to say no? Is it like highly cyclical, right? Is there a lack of developed infrastructure? Meaning is it like a team of like 3 people, or is there like a nice management team in place? How sophisticated is the sponsor? Will they understand the financials and how to run this type of thing? Or are they just somebody kind of, YOLOing with an SBA loan? That's pretty terrifying for them. and for us. How easy is it to disrupt the company? The thing we've used is like, can it be disrupted with a website and $100,000 of marketing?
Yeah.
I gave this example in a forum recently, because I mentioned this on another podcast, and somebody was asking like, well, what specifically, like, how can I think about this?
Mhm.
It's like, so imagine a roofing company, and this roofing company is just really good at SEO. And so they get all these SEO leads coming in, and then they take all the leads and they just kind of like distribute them out to subcontractors who don't really work mostly for this company, just whoever, subcontractors. And let's say this company's making $1 million a year. That's awesome. And maybe they can try to sell the company for like $3 million, $3.5 million. Should somebody buy that? No, they should instead build a really nice website and spend $100,000 on really good SEO.
Yeah.
And do this exact same thing. Now I'm simplifying it harder than that.
It's actually that really resonates with me though when you say that, because when I am looking for, I have a couple properties. When I'm looking for a contract job, hey, I need a HVAC person, I'm calling. It's all companies like you're describing, where it's somebody trying to connect to the HVAC person, where it's like, no, I actually just need the person that's doing the job to answer the phone.
By the way, the example is exactly, I had an SEO agency back in the day. That's exactly what I would do with a lot of companies.
Yeah.
Great example.
I still own an SEO agency. That's one of my wholly owned companies.
Oh, it's great.
And so I know it. And I'm like, all the time, I'm like, no, like, you don't want to pay 3.5x earnings on that.
Right.
You just want to replicate it. And again, maybe you don't get to as big as they're doing, but if you get halfway there and spend 30x less capital, like that's what you want to do. So there's that. There's a concentration risk.
Mm-hmm.
Does like one client make up a huge portion of the revenue? And in some cases, that's okay. Let's say a client is like really integrated with the company and has been there for like 15 years. We get comfortable with it, but or maybe like there's certain industries that are just like by nature highly concentrated. But
it's a good point. Is there, when it comes to concentration, is there kind of a benchmark that you guys use? Like, we don't want one client to be more than 25% generally, or
that's, we've looked at making like checklists with this, but I think you really just have to use judgment on each of these.
I think everybody can have their own individual mandate here, right? On their concentration level. So I guess
everything's different.
Yeah. I guess stepping back, I kind of look at it as a funnel, right? You say no, you vet through this process till it gets to the bottom, and that's when you really do your due diligence on whatever criteria of companies that you're looking to make a decision on.
Yeah. There's much more. I mean, there's like, we look at how challenging is the industry, like how challenging is it to understand? Some things, like they're trying to explain it to us and we're like 30 minutes in, we still don't completely understand. We're just like, nah, this goes in the too hard pile. Sometimes the valuations are just too high. With this space, like if we find a decent company under like 5x multiple, like it can pencil out really nicely. You start getting above that and it doesn't. Doesn't mean it's a bad deal. It just means it's less of a no-brainer. And then we look at, like, is there too much leverage? Is like the governance or the terms weird? Are the weird economics are they asking for too much? There's all kinds of stuff. We can go on for days with that stuff.
Yeah. So going back to, you create Capital Pad, this platform, you're getting deals based on your experience. Is that just to kind of create this deal flow mechanism through this platform?
Yeah. The way we think about it is it's like basically angel list for like cash flowing small businesses. So it's a way for people to fractionally invest in these things. And what value are we adding besides just like streamlining it is the big one was curation. So when we started, they were like, oh, is this going to be like an open marketplace, or are we going to curate it? And within the first week, we're like, oh no, we're going to curate it heavily. And so that's what we do. So we all those things I just talked about of like things to say no to, these are like my personal criteria for investing. And if I'm not personally going to invest in it, it's not going to go on the platform. And so that's kind of like how we're doing that. There's no right or wrong way. Like there's, other people doing just like, here's all the things, you can invest in whatever. And I think maybe somebody's really sophisticated in the space, that might be okay. But there'd be a lot more noise to sift through. But, a lot of people are maybe like sophisticated finance people or sophisticated business people and understand it, but maybe don't understand the little intricacies around this space that make a really big difference. And so we feel more comfortable with like the highly curated model.
Let's talk a little bit about your models. So you mentioned you guys have these kind of models that you're using for maybe looking at things like EBITDA, different things like that. What do your guys' models look like when it comes to uh, the investment side of this?
Well, I'm not completely sure how to answer that one for like what you're looking for. I can tell you the things like we want to. It needs to pencil for us with the models at like low growth scenarios and where we come out at over 30% IRR, basically. Um, and there's IRR gets kind of met like that the more you extend out the timeline, like it changes that type of thing, and so that's kind of a rough gauge that we use, and it's also not maybe we see a company that we think is completely bulletproof and it's a little bit lower than that, and we'll kind of think differently, but for most of these, we don't get out of bed if we're not making over 30% a year. But also like on average, there's a lot of studies like Stanford does a search fund study. There's a couple others. Roughly 10% of these are failing. It looks like that's the ones with the SBA loans. The Stanford one shows a little bit different data, but it's used differently, so it's hard to say. You kind of model that too. So if we're looking at 35% IRR, we got a couple failures in there. We do 10 of these. We're still in the high 20s, low 30s type of thing at the end of the day.
Makes sense.
Yeah.
So I guess,
but you're not going to get 1,000x return like you do with venture. You get some 10x's from time to time, but like that's it's different from the venture model.
Right. As far as just the exit process, I mean, how long are you guys in a deal, and what does that look like?
It really varies. There, a lot of deals are trying to get like in and out in 5 years. They identify the companies, they identify all the levers to pull, and so they're just going to try and do that and then resell it in 5 years. I definitely like the deals that are like we're going to attempt to sell in 5 years, but if like market dynamics don't allow for that, we'll just keep running it longer because again, it's profitable. You got runway. Some of the companies people are aiming to just run for the long term, and personally, as an investor with a very long time horizon, that's what I would like. Like I love it if somebody's like, oh, I want to run this business for 30 years and just make distributions. I'm like, yes,
that's great.
Sign me up. Like I just want a collection of those. And with those deals, they usually give a option to investors, like at year 5, like sometimes a little bit longer. Like they will offer to buy out investors, which is better for them because investors are expensive. If you look at the returns of these companies and how much the investor owns, like if it's a stable company and they can replace the investors with like debt, like it's much cheaper actually. But I'll only invest in deals where that's an option for investors, not forced. I don't want a forced put option. Like I don't want, okay, the business is getting good, now let's buy me out for
You don't want.
So they bring like a predetermined like valuation multiple or like a third party valuation person to come in and they offer to buy out the investors. So those are different ways for it. There's no one way, there's no right way, just kind of whatever. And with like Capital Pad itself, we have different deals of different structures. So people can like pick what they want. A lot of these deals pay out quarterly cash flow. Some of these deals don't pay anything. They're just going to, they're doing a roll up, for example, to buy like lots of business in the same industry, and they're going to try and resell in like 5 years. So they're going to use that capital. But like there's different deal structures for like whatever somebody's looking for, essentially.
Very cool.
Are there any particular business niches that you found to be the best, or like any type of this type of company comes in and you get real excited about it?
I get excited about like all these different words. I don't think due to SEC regulations I can talk about our 2 live deals, but I'm looking at like the past ones and like a New Jersey home repair, like the pool servicing roll up.
I guess any specific market dynamics or trends right now that you're seeing?
I tend to avoid some of the hot stuff. So like, HVAC companies, everybody wants to buy an HVAC company and they're good companies, but they're also really hard and they're valued fairly, I would say, if not high. So that's difficult. I'm not against software companies or agency type of things,
Mhm.
but I'm more weary of those due to like disruption.
Right.
So, if you look at like AI could change all kinds of stuff right now, but AI's go back to like our roofing analogy, like it's not going to change roofing really. So, like that, plumbers are still going to have to get down there and like change the pipes themselves. So that's something I feel more comfortable with where like an agency, even though I own an agency myself and know how profitable it can be, like, do you want to like buy that, put debt on it? Like that type of disruption kind of, it makes me nervous. And same thing with software. I think software is easier to build now and can be disrupted a little bit easier. And I think forever we thought, software is so sticky, and it is, but I'm not sure it'll stay like that. So I'm more hesitant to do those deals. Not saying no, we're open to it. Just more hesitant.
Yeah, absolutely.
Yeah, we like boring stuff. That's kind of the thing. And if I was to pick, well, this is actually what I do. Obviously, I'm building Capital Pad, but I still have other companies. I like to build in things that are less boring, and I like to invest in things that are more boring, right? Because I think if I'm building something in a more exciting industry or an industry that was like high growth, there's just all kinds of different things. If you're just building something, you can create a lot of value. But when it goes to investing, I see when people try to go to like those huge reaches, they just tend to lose their money more. And I want to, like, I know my skill set's really good for building this type of company. We've talked about the SaaS companies, the marketing agencies, whatever. Will that skill set still be around in 10 years? I don't know. And so I'd much rather take all my capital and put it into things that I know will be there. So I'm kind of like barbelling it essentially.
Yeah.
Like make money in this one thing and then like sleep in peace knowing that my capital is in these boring things.
Yeah, that's an interesting thought process. Yeah, obviously consistent, boring returns that, that great, right? There's no craziness that's going to happen, but on the other side, you are swinging for the fences and do different things, looking at the upside.
Yeah. And again, the historical returns, it's kind of an anomaly. The historical returns for these, like the Stanford Search Fund study, I think the average IRR that they talk about for all the participants is like 35%. That's bonkers high. Right? And this isn't me telling you this. This is Stanford saying this. But it's also at the same time boring companies. Like, come on. That's pretty. It's kind of an anomaly. You don't really see that anywhere else. And again, I attribute it to being the space can only hold so much capital. It can't hold this institutional billions to like dilute the returns is kind of what it comes down to.
That's what
makes sense. With the companies you guys work with, is there, I think you might have touched on it a little bit earlier, but is there like kind of like an advising aspect? Like, as you guys are working with these companies, is there things like, hey, like, I think you guys could do this better, do that better?
Yeah.
And I think you even gave us an example earlier about like SEO.
Yeah. So we definitely do. Our team is the Capital Pad team. We've got some pretty interesting people on there. So I think everybody at this point probably understands my skill set. My co-founder is former private equity principal of a $1.5 billion fund. So he is incredibly talented at so many things. He doesn't necessarily have this like nitty gritty hands-on small business experience like I do, but that's a good thing because we pair really well. Our other co-founder is the technical co-founder. So he's very technical to help with that. And then we got a guy who's just a former investment banker, but just like he's not an investment banker at heart. He's more of like a startup, like grit, like whatever it takes, like very empathetic and see through customers' point of view. So with that, and with our very much extended network, we can kind of solve a lot of problems for companies, whether it's finance, whether it's marketing, whether it's like operations. And so we can help them solve those problems. And we do, because it helps our returns. It helps our investor returns. I'm investing in these things myself too. So it really just makes a whole lot of sense. I mean, again, that example we just gave, like, my agency is going to take over most of the SEO for that company, and like at cost. Like, I'm not going to make profit from this. That doesn't really work, I don't think. What's that related party transaction type thing? But yeah, so we can add a ton of value even post closing or during the closing with my co-founders skill set. So that's kind of what we're aiming for, to make a difference in these companies at the same time we invest in them.
It's cool. Yeah, sounds like something to be helpful for the sponsors for these deals.
Yeah. It also helps us get the deals.
Yeah.
We have a deal that I just love right now. It's so unique. Again, I can't talk about it because of the SEC stuff, and I wish I could. You guys would love it. Like you two right here, you would be like, what? This doesn't like what? But I forgot where I was even going with that. But like, there's so much low hanging like marketing fruit with some of these that I just come in. I'm like, oh, we're just gonna just take care of this, and I think that's why we're winning the deal, because they want that. If the sponsor,
it's a big value add.
Yeah, it's a huge value add. They want people who's really going to like make a difference. You hear with like the VCs all the time, like value add and venture, and probably like very few of them actually do. Well, I think we actually can with these, and it's way easier to add value with these than something in venture. Venture's like, if you're building a startup from scratch, man, it's hard. It's hard. I don't know how to do all that. I mean, I've done it, but I don't know how to like tell somebody to do something. But with these established businesses, like, oh, I know exactly how to do that lever.
Yeah.
And you just
pull. It's really simple stuff a lot of times.
Yeah. And things like you just have to know.
Right.
So it's not rocket science.
Yeah. That's very interesting. Yeah. Very cool.
Let's talk about bad deals. This is one of my favorite. Let's hear about some of your worst nightmare stories that you've had in this space.
So luckily I haven't had too many
Yeah.
Terrible deals, but all right, so Jason Calacanis, I mean, everybody knows him now for the All In podcast, but he wrote a book called about angel investing. And he gave some really good advice, I think, which is when you're starting angel investing, like go to AngelList, sign up, and put like the minimum, which I think is $1,000 in each deal, put it in like 10 different deals, and then just wait and learn. Because if you just start investing heavily from the start, you're probably going to make bad deals. And I can speak from experience. That's exactly what I did in angel investing. I've made like 50 or 60 angel investments. I'm like, my first 10 were garbage. Yeah. maybe more than 10. They were garbage, and not because they didn't work out, but because like the logic and reasoning behind making the decision was poor. And so it's kind of the same thing in this space for me. Like my first couple weren't great. I mean, they haven't failed or anything like, but they're not doing it. One was, it looks so good on paper, and we're like, oh, it's it's diversified, low customer concentration, and then like an industry shift that was kind of a bubble happened like in the whole industry, and then it just like wiped out like half the revenue. Maybe not half, but like a huge chunk within like a year post closing. What we thought was diversified actually wasn't. I would love to give you more details, but I think it might. I think it might like expose the company a little bit more. I don't want to do that. Let's see. Honestly, there haven't been any major failures or anything. They do happen. They definitely happen in the space, but I think at this point, like, pretty good at just saying no to things that don't look like, easy hits, easy swings, or whatever.
Yeah. Do you have any stats you could share on like failure rate?
So Heather Andreessen, who is a SBA loan broker for people searching, she put out some stats. It's kind of hard to get. So the SBA default rate on these 7A loans is around 10%. And again, this is for the, like the searcher deals, which are a little bit smaller than like the big ones, and 10%. But that doesn't necessarily mean it's just because it's not defaulting that the investors are swimming in the money. Maybe it's just like surviving or something like that. So, but you could say a 10% failure rate there. The Stanford study shows a little bit higher, but it's because a lot of the funds like didn't actually find a business to buy, and so it doesn't quite work out. So it's kind of hard to go from that. I think the personal opinion, not related to Capital Pad, is probably like 10 to 15% of deals don't work out on average. And we actually just recently looked at some of the stats from the independent sponsor deals. Independent sponsor deals we didn't really go into. These are just bigger deals. The economics are a little bit different, actually probably a little bit better for investors. But yeah, the failure rates are pretty low on those two. And I think like 74% of those deals returned like 3x or more. So pretty good stats with those things. The failure rate's not, it's kind of wild. But again, you're buying boring stuff. Like the big problem to watch out for is how much debt are they throwing on there?
Okay.
You know, leverage is great when it works well. If it doesn't, like, you know, you hand the keys back to the lender. That's what you got to watch out for. We just passed on a deal where it actually broke my heart because the sponsor, so talented. Also just such a nice guy. His like pedigree, his background, he's been like every company you'd want, he's done everything. Like he's a private equity guru. And this company was really cool, but like we couldn't quite get comfortable with the amount of like upkeep some of the parts of the business might get, like, you know, the CapEx needs. And so with that, we're like, well, if he's adding this much leverage on the company, what if a surprise comes? Now you're underwater with your covenants and you got to hand the keys back and you lose it. So just got to watch out for that stuff. This was not a good answer for you guys.
This is great. I guess from as people come into this space, you know, if they want to get into the capital pad and make an investment, right? I mean, you gave some great advice. What other advice would you give someone who's starting out? AngelList was a great example, as you mentioned. But what other advice from your lens would you give to someone looking to do this?
I'm all for, again, like starting small on that. Even though I obviously benefit if you don't start small, because we take capital pad, we take a carry from investors. You know, once you get your money back, like we start sharing in the profits. I think don't be afraid to ask all the questions, because even though so much of this stuff is not normal, but is more like table stakes knowledge, there's a lot of little intricacies that aren't. Like the step up example, like most people don't know about that. Even like, you know, private equity people don't understand that term all the time. There's little terms like that, like just ask. Also, like in the platform, once people, so when an investor comes in, again, accredited investor comes into the platform, they get to see a teaser for a deal. And the teaser has a little, like, you know, 3-minute, 2-minute video clip of the sponsor talking about it. And you get to see a kind of anonymized video of it, of the deal. You get to see like the highlights. You get to see, you know, the financials for the last few years, the sources and uses, that type of stuff, deal terms and expected returns based on their model. Then you got to sign an NDA, like on the platform. Once you sign it, you get access to the full deal room. So you can see like the entire deal project, all like past tax returns, like all this stuff. And then you get connected with the sponsor via DM. So the searcher, the sponsor, and now you can like actually talk to them. So you ask them questions. Like it's actually good to challenge them too, because the actual best case, this isn't the best case scenario, but a great scenario is if you ask them a question that they hadn't thought about and they back out of the deal, right? Like that's actually a good thing. We haven't seen that happen, but so like ask them tough questions, learn about this stuff. I think that's great for everybody. That's what we're doing. We're asking the tough questions and we want everybody else to ask them too. So all learn together.
Yeah. It's good advice. It's helpful for the investor and the sponsor. It sounds like.
Yeah, I think so.
Yeah.
Cool. Well, Travis, I think this is a good spot to wrap up. This has been a lot of fun. Really appreciate you taking the time to chat with us. Where can people go to connect with you and learn more about Capital Pad?
Just capitalpad.com. You can, once you land there, you get to choose your own journey, whether you're a searcher, sponsor, or an investor. And then it takes you down that rabbit hole for signing up. That's really it. I mean, you can follow me on the socials, Twitter, LinkedIn, whatever. Other than that, Capital Pad's a spot.
Awesome. This has been great, Travis. We'll make sure to include all that in the show notes.